Hey everyone, thanks for joining us again for another deep dive. You've been sharing some really interesting articles this time around, all focused on Canadian markets and business. It's great stuff. So today we're going to unpack it all, pull out the important bits, and hopefully give you a better grasp on what's happening and why it matters.
Yeah, you've given us a really fascinating mix this time. We've got analyst reports taking a close look at Canadian natural resources. We've got a report digging into insider buying activity in the oil and gas sector. We'll also tackle some updates on upcoming tax changes for Canadian businesses. And then to top it off, we've got an analysis of how a weaker U.S. dollar could shake things up for TSX stocks.
And it all kind of connects in a way, doesn't it? I mean, we're going to start with something very specific, like the performance of one particular company's stock. But then we're going to zoom out and look at bigger trends in the energy sector. Then we'll factor in government policies and finally even global currency movements.
Exactly, it's all connected.
Okay, so let's dive right in. Let's start with this Scotiabank report that basically shouts buying opportunity when it comes to Canadian natural resources. What's the story there?
Well, the interesting thing is why they're saying that. Scotiabank upgraded Canadian Natural Resources, that's CNQ.TO, on the TSX. They upgraded it to sector outperform. And their analyst, Kevin Fisk, he points out that CNQ's stock price hasn't really kept up with the rest of the pack over the past year. Like, it's lagged behind international energy companies. It's also lagged behind its Canadian rivals like Suncor and Imperial Oil.
Yeah, I see that.
Yeah, so CNQ is down about 15%. While those other companies, those peers I mentioned, they've only slipped to about 8% since all this talk about U.S. tariffs began.
15%.
Yeah.
Yeah, that's a pretty noticeable drop. So is the analyst suggesting that the market is overreacting a bit? Yeah.
Yeah, that's the gist of his argument. Fisk is saying that when you look at the changes to CNQ's projected cash flow per share for next year, they've actually only been revised down slightly, like around 3%. So he thinks that big drop in share price is an overreaction, to those tariff worries and the lower oil prices, especially because their financial outlook hasn't really changed all that much.
I see.
So basically, he's saying that this underperformance is actually a good thing for investors. Like, it's a chance to buy a really solid company at a discount.
So a short-term dip could translate into a long-term gain. Is that what he's saying?
Yeah, that's the idea. And Scotiabank is sticking to its $56 price target for the Toronto-listed shares. And a big part of their optimism hinges on the trade situation with the U.S. They think it'll smooth out eventually. And they point out that the tariffs have already been pushed back. And the potential tariff on Canadian energy, well, that got knocked down from 25% to just 10%. So the feeling is that if they can resolve this whole trade thing completely, then C&Q's strengths will really start to shine through.
Okay, so trade tensions are a factor for sure, but it's not just about trade, is it? I mean, oil prices are a huge deal for a company like Canadian Natural Resources.
Oh, absolutely. Fisk really emphasizes that. He says C&Q is poised to benefit big time if oil prices go up. And he lays out a couple of scenarios. So if West Texas Intermediate, that's WTI crude oil, if it averages $70 a barrel, then C&Q is on track to hit its $15 billion net debt target by late 2026. But if WTI climbs to $80 a barrel, then they could hit that target even sooner, like by the second quarter of 2026.
And reaching that debt target, that's a big deal for C&Q, right?
Yeah, it's a major milestone for them. Once they hit that $15 billion net debt level, Canadian Natural Resources has said they're going to boost the amount of free cash flow they use for stock buybacks. After they pay out their dividends, they're going to bump it up from 60% to 70%. So they're basically putting more emphasis on giving money back to shareholders. And that's a big reason why analysts are so bullish on the stock.
That makes sense. So it sounds like Scotiabank isn't the only one feeling good about C&Q. You mentioned a report from RBC as well that was pretty optimistic.
Yeah, RBC's take was even more bullish.
Yeah.
Back in March, their analyst Greg Pardy, he went as far as to call Canadian Natural Resources the most compelling buying opportunity out of all the major Canadian energy companies.
Wow. The most compelling. That's a strong statement. What's behind that level of conviction?
Well, they're looking at a few key things. First, they see the leadership at C&Q as strong and aligned. They also like the company's commitment to shareholders. Then there's the fact that C&Q consistently generates free cash flow, no matter what the market's doing. RBC also thinks their operating performance is top-notch. Yeah. And then, of course, there's that commitment to returning value to shareholders through buybacks and dividends. Oh, and they also point out that C&Q has a pretty attractive dividend yield. It sits at 6%. So they're basically saying that investors are getting paid to wait for the stock price to go up.
Interesting. So it seems like there's a consensus building among some analysts. They think CNQ is undervalued and that this dip might be a good entry point for investors.
Yeah, that seems to be the sentiment right now.
Okay, so we got the analyst perspective. Now let's switch gears a bit. Let's look at what the insiders are doing in the Canadian oil and gas sector. You highlighted a BMO Capital Markets report on insider buying. What did that tell us?
This report gives us a really interesting glimpse into what the people running these companies are doing with their own money. BMO Capital Markets noticed that some key insiders at a bunch of Canadian oil and gas firms, well, they were buying up a lot of their own company's stock. And this was happening during all that uncertainty about U.S. trade, those potential tariffs on energy imports.
Right. So they were buying even when there was a lot of fear and uncertainty in the market. That's a pretty powerful signal, isn't it? When the people at the top are putting their own money on the line like that.
Yeah, it definitely suggests something. And the report actually says it pretty bluntly. They say, although there are many reasons why insiders sell shares, there's usually only one reason they buy. They think the stock price is going up. So the idea is that these executives felt like their companies were being underestimated by the market, like their stock was undervalued, given everything that was going on.
Okay, yeah, that makes sense. So this kind of insider buying, it's often seen as a positive sign, right? Like it shows that management has confidence in the future of the business.
Exactly. It's a vote of confidence for the people who know the company best.
So which companies saw the most insider buying activity?
BMO's analysis showed that the top three were Cenovus Energy, that's CVE.TO. Then there's Spartan Delta, SEETO, and Kelt Exploration, Kel.to. And those same three companies also had the most buying activity coming from their CEOs specifically.
Makes sense. The CEO's actions usually carry a lot of weight. Like it's a strong signal of their belief in the company. But the report also talked about different types of insider buying, right?
Yeah, that's an important detail. They make a distinction between buying by the, what they call it, the operational engineering body of the management team. So that would be people like chief operating officers. The thinking there is that when these folks are buying stock, well, their decisions are probably based more on how the company's assets are actually performing, rather than just broad market trends or predictions about commodity prices.
Ah, I see.
So it's like a more direct reflection of their confidence in the core business itself.
Yeah, that makes sense.
And the report also pointed out some instances of what they call broad-based insider buying. That's when you see buying activity not just from the CEO and CFO, but from other officers and directors across the whole organization. And they highlighted companies like Whitecap, Peyto Exploration and Development, that's PEY.TO, and Saturn Oil and Gas, Osoil.TO. They said this kind of widespread buying across the company is less common.
And it could mean there's a really high level of confidence internally, like across different departments. So basically, you've got these analyst upgrades suggesting that certain companies might be undervalued, and then you've got this insider buying activity, particularly from those in the operational side of things and also across whole organizations. It kind of paints a picture of potential opportunity in the Canadian oil and gas sector.
Yeah, it's definitely something to watch. It suggests that there might be more to the story than what we're seeing on the surface.
Definitely. Now let's shift gears again. Let's talk about something that affects every business in Canada. Upcoming tax changes in 2025. This might not be directly related to picking stocks, but it's definitely important for anyone running a business.
Oh, absolutely. This is crucial stuff. Understanding how the tax landscape is changing. It's essential for any Canadian business to stay healthy and plan for the future.
For sure.
And the article you shared, it points out this trend of growing complexity in business taxation. And that unfortunately means higher costs for businesses to stay compliant.
More red tape and higher costs. Yeah, that's a familiar headache for business owners. What's driving all this added complexity?
Well, one big factor seems to be the sheer number of tax credits and deductions that are out there. The article quotes an expert who estimates that there are over 400 of them.
Wow, over 400.
Yeah, it's a lot to keep track of. And it makes it really tough for business owners who aren't tax experts to navigate the system properly. And make sure they're taking advantage of everything they're entitled to. It really highlights the need for professional help in this area.
Yeah, that sounds incredibly overwhelming. So what's the main takeaway for business owners as we approach 2025? What do they need to keep in mind?
The article really stresses the importance of starting tax preparations early. And while that's good advice for everyone, it's especially critical for business owners. because they usually have a lot more information to gather, and things can get pretty complex. Starting early gives them time to get organized. It reduces the risk of making mistakes or missing deadlines, and it gives them more time to sort out any issues that might pop up.
Right. That makes sense.
And this whole thing with growing complexity, it might mean that businesses need to allocate more resources to tax compliance, which could hit smaller businesses harder.
I see.
Yeah. And could also encourage businesses to think more strategically about tax planning, earlier in the fiscal year.
Right. Planning ahead is key. And speaking of key dates, it's always good to get a reminder about tax deadlines. What are the important ones for Canadian business owners?
Okay, so for most individual taxpayers, the deadline is still April 30th. Self-employed individuals get a bit more leeway. They have until June 15th to file their return. But it's important to remember that any taxes they owe are still due by April 30th. As for corporations, their filing deadline is within 6 months of the end of their tax year.
Okay, good to know. Now, there's been some talk lately about changes to capital gains taxes in Canada. Did the article touch on that at all, like how it might affect businesses?
It did. There was a proposal to increase the capital gains inclusion rate. That's the portion of a capital gain that's taxed. The federal government was thinking about raising it from 1/2 to 2/3, and that would apply to corporations, trusts, and individuals with capital gains over $250,000. But that particular change, it didn't go through as planned.
Interesting.
Yeah, the article even mentions that the initial plan caused some confusion because some tax slips were still referencing the original implementation date.
Oh, wow. So it sounds like there was a bit of a mix-up there. So for the 2025 tax year, that proposed increase to the capital gains inclusion rate is off the table.
Yeah, that's right, at least for now. The article suggests that the change in leadership in the Liberal Party basically put that proposal on hold. But it's important to note that there's still a planned increase to the Lifetime Capital Gains Exemption limit.
Right.
That's set to go up from $1 million to $1.25 million. And that could be a big plus for business owners when they decide to sell their companies.
So one potential tax increase is on pause for now, but a beneficial exemption is still going up.
Okay, got it. Well, let's move on to our last topic for today. The CIBC Capital Markets analysis on how a weaker U.S. dollar in 2025 could impact TSX-listed stocks. This has pretty broad implications for the whole Canadian market, right?
It does. CIBC Capital Markets thinks that the S&P TSX Composite Index is likely to head upwards in 2025, and they believe a weaker U.S. dollar will play a role in that.
Okay, so what's behind this prediction of a weaker U.S. dollar?
Well, their analysis points to a couple of main drivers. First, they're predicting a less robust economic outlook for the U.S. compared to other major economies. And second, there's this feeling in the market that a potential Trump administration might actually want a weaker U.S. dollar, maybe as a way to manage the country's foreign debt.
Interesting. So how does a weaker U.S. dollar translate into potential gains for Canadian stocks on the TSX?
The key here is the amount of revenue that TSX-listed companies earn in currencies other than the Canadian dollar. CIBC Capital Markets estimates that it's about 60%.
Wow, 60%. That's a big chunk. Yeah, so if the Canadian dollar gets stronger compared to other currencies, including a potentially weaker U.S. dollar, then when those companies convert their foreign earnings back into Canadian dollars, their earnings look bigger.
I see. So it's like if you earn money in a currency that's becoming more valuable compared to your own currency, then suddenly you have more buying power at home when you convert it.
Exactly. And that's basically what they're referring to as earnings tailwinds. Yeah. It's this potential boost to their bottom line throughout 2025.
So companies that make a lot of their money in U.S. dollars or other foreign currencies, they could see their reported earnings go up just because of the currency exchange.
That's right. The report specifically mentions that companies with a lot of non-Canadian revenue, and they report their earnings in Canadian dollars, they're likely to see some positive surprises in their earnings reports, especially in the first and second quarters of 2025. They benefit from having that diversified revenue stream outside of Canada. And then they get this added bonus from the favorable currency exchange.
Makes sense. Are there any particular sectors on the TSX that are in a good position to benefit from this?
Well, the report talks about Canadian oil and gas producers. And as we discussed earlier, they usually book their revenue in U.S. dollars. But a lot of their expenses are in Canadian dollars. So theoretically, a weaker U.S. dollar could give them a bit of a boost. But the analysts also point out that for this sector, the bigger swings in commodity prices, which are usually priced in U.S. dollars, those swings tend to have a much bigger impact on their profitability than currency fluctuations.
Right, so the price of oil itself is a much bigger factor than the exchange rate.
Exactly.
What about the recent jump in gold prices? The article mentioned that briefly as well.
Yeah, the price of gold has definitely been on the rise lately. It went over 3,000 US dollars an ounce. And the report highlights that the S&P TSX has become a major hub for gold mining companies. They now make up almost 10% of the index's weighting. So that strength in gold prices is another potential driver for positive performance on the TSX.
Okay, so to recap, we've talked about potential opportunities in Canadian natural resources. Based on what analysts are saying and how the stock has been performing, we've seen some strong signals of confidence from oil and gas insiders through their buying activity. We've looked at the growing complexity of tax reporting for businesses in Canada, and we've discussed how a weaker US dollar could be a tailwind for a lot of TSX-listed companies that have international revenue streams. It's been a pretty wide-ranging look at some key areas of the Canadian economy.
Yeah, it really has. I think by looking at all these different sources together, we get a much clearer and more complete understanding of what's happening in the Canadian market right now and where things might be headed.
Absolutely. So for you, our listeners, as you process all this info from the sources you shared with us, what parts of the Canadian market stand out to you now? What areas might deserve a closer look in your own research or decision making? And how might these interconnected economic forces influence your overall perspective on Canadian investments or your business strategy in the coming months? There's certainly a lot to think about. Thanks for joining us for this deep dive. We'll see you next time.